Rig owner Transocean reduced its losses during 2018 as revenues rose, however the company's underlying performance slipped. Transocean posted a loss of $2 billion for the year, an improvement on 2017's net loss of nearly $3.1 billion. The company noted that its 2018 results included a $1.5 billion loss on impairment of goodwill and 8 floaters previously announced for retirement, $143 million in discrete tax expense, $34 million in acquisition costs and $3 million related to other unfavorable items. These costs were partially offset by a $10 million bargain purchase gain and $7 million gain from the disposal of assets. Taking into account one-off costs, Transocean reported an adjusted net loss of $369 million, an increase on the $24 million adjusted net loss reported a year earlier when results were weighed down by a $1.5 billion asset impairment and nearly $1.6 billion loss on the disposal of assets. The weaker underlying performance in 2018 came despite revenues edging up 1.5% to just over $3 billion as increased fleet utilization helped offset a fall in day rates. Transocean achieved an average day rate for its fleet of $296,200, which was down from an average of $321,300 a year earlier. However, its fleet utilization rate rose from 48% to 59%. 2018 will be remembered as a transformative year in Transocean's long and storied history, Chief Executive Jeremy Thigpen said. Through the acquisitions of Songa Offshore and Ocean Rig UDW, we added approximately $4.5 billion of high-margin backlog. And, when combined with our investment in a joint venture to market and operate the Transocean Norge, over the course of 2018, we added 21 rigs to our fleet, including 15 of the highest specification ultra-deepwater and harsh environment floaters in the industry. Thigpen noted that the company also booked 37 new floater contracts in 2018, which was nearly double the amount booked in 2017, adding almost $2 billion to Transocean's backlog, which was the company's largest annual total in 4 years. As evidenced by the increase in contract awards, we believe that 2018 marked the beginning of a recovery in the ultra-deepwater market, he added. While oil prices remain volatile, the efficiencies that we have realized over the past few years have materially reduced offshore project costs and compressed the time to deliver first production, thereby minimizing our customers' risk and improving the attractiveness of offshore projects. In fact, current customer conversations suggest that FIDs in 2019 could increase materially over last year. Transocean's total contract backlog stood at $12.2 billion in its latest fleet status report, which was released earlier this month.